Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen. Hello, everyone. Welcome back to the CreditSights No More Risk Better podcast. This is Winnie Cisar, Global Head of Strategy at CreditSights. And today I have a fan favorite, Kerry Kantin. She is the Bureau Chief for the U.S. for LevFin Insights, LFI, a CreditSights sister company, a Fitch Solutions company. She's been on the podcast before, and I am really excited to talk about all things loan related. Kerry, thanks for joining.
Thanks for having me, Winnie. Certainly an interesting time.
Very much an interesting time. And this is a little bit funny because, Kerry, you are normally based in New York, but today I see you sitting in the Charlotte WeWork, the CreditSights hub of Charlotte. How is it there?
You know, it's good. I like the WeWork. We worked in one, actually, when we first started up. LFI is almost 10 years old. And when we first started out for the first few months, we were in a WeWork, and I loved the free coffee.
So did you have some insider information when WeWork was being dragged through the news with all of their restructuring?
We did not. We did have a lot of visits from our neighbors' dogs, but we did not get any insider information.
Even better. Visits from dogs, better than inside information, much less likely to lead to jail. So that is always a useful thing.
Indeed.
All right. Kerry, I hope that you have fueled up with some of the snacks that we have in the office. Lots of candy, unless Davis ate it all. But I guess we should talk about the loan market rather than just talking about WeWorks. And I think what is really interesting is just how different expectations and reality have been this year. When I think back to the end of 2025, everyone I was talking to was thinking about the return of M&A, LBOs coming back, sponsor-to-sponsor transactions, all of these things that were kind of defining the tail end of 2025, accelerating into 2026, just given how strong primary market conditions were across a wide range of markets. And instead, we've been grappling with the U.S.-Iran conflict, oil shocks, private credit woes, the software fears, and then a massive repricing of Fed expectations, which I think is especially notable because as I was talking to LevFin participants, everyone was really focused on, okay, if rates can just come down another 100 basis points, that's going to be like game on for everyone in LevFin. Can you walk us through how the loan market has reacted so far to some of this volatility? Did sentiment really shift from that positive to negative? And was it a quick shift?
It was an extremely quick shift, actually, because in the beginning of the year, the market started off strong. As you were saying, everyone was kind of all bulled up at the end of the year. There was going to be a bunch of M&A. And this is kind of common around the beginning of the year. But you wind up with this sort of dearth of new issuance for a few weeks. And so the lack of new issuance and a lot of deals sometimes close around quarter end. So the market was flush with cash. And when in the loan market, the R plus percentage was elevated. So we kicked off the year with a ton of repricings. The market felt super strong, but sort of some of the software fears began creeping in. And it was the last week of the month that there were a ton of deals in market, many of which were repricing, most of which made it through. But it was sort of like there was one day where you almost like felt the market shift, and then issuance slowed appreciably in February. Like one thing to remember about leveraged loans is there's a lot more exposure to sort of sponsored tech business. It's roughly 15% versus 6% in high yield, I believe. And so there was a lot of sort of angst around that. And February, interestingly enough, actually had a worse performance than March did, because loans are quite as sensitive to rates as high yield and IG are. Now, the new issue market continued to though back up in March. And now in April, even though there's still no conflict around, I mean, the conflict in Iran is still going on, and still a lot we don't know about how AI is going to impact the market. Um, the market seems to have found some sort of footing to get deals done. We actually have 20 loans in market right now, which kind of feels like the most we've had in a while.
Yeah,
So
April was interesting. April is supposed to bring showers, I guess. I think the only shower were showers of new deals, because if you look at the investment grade market, that came in well ahead of expectations. The high yield bond market posted its busiest month in quite some time. I would say the leverage loan index or leverage loan market, just looking at, kind of how the activity shook open, was maybe a little bit slower overall. Do you think that the market is, truly back open? Did April give it some momentum? Is this a head fake? How quickly could it kind of close up again?
I mean, I don't know that I'd say we ever fully closed like we did in April of 25, where there was like a few weeks, I think, in which there was no issuance. But no, loans for the loan asset class, which for those of you who aren't super close to it, we have very weak call protection, so the ability to reprice can generate huge volumes. So by loan market standards, it was slow. In fact, high yield was actually busier, which is rare. Save for there was a long stretch in 2020 when this happened, because after rates fell post COVID, that sort of the high yield saw a rush of issuance and loans were kind of quiet back then. But I mean, I feel that April saw there were a bunch of deals for sort of well-regarded names um, with that aren't deemed to be AI sensitive, that generated a lot of traction. And I think this has emboldened issuers to come forward. Another interesting thing, sort of from the technical perspective, is our forward pipeline of deals. As you were saying earlier, we were expecting this big year for M&A, and the pipeline of deals has dwindled to something like, it's a bit of a moving target, but like 23 billion from 54.3 billion at the end of the year. So there's not that much, underwritten supply that's poised to come. And March and January, March and April were also pretty big months for repayment activity. So essentially, the technical landscape, even though CLO issuance slowed, is in like favor of issuers and arrangers right now. So I think we're starting to see, more borrowers kind of say, okay, we can navigate the volatility. We can do this.
Yeah. Yeah, it's interesting that, the net supply that we looked at in the investment grade market or the high yield market is actually up a little bit because of all the hyperscaler funding in the investment grade market. High yield has just had kind of a wide range of different types of deals that have been coming to market. One thing that I think is really notable is a headline deal from late April, which was CoreWeave. So this is a GPU-backed term loan B. It's the first one to come to the broadly syndicated market. This has been kind of a place where private credit has done a lot of deals with GPU transactions. Why is this happening now? Like, what made this kind of the right moment for CoreWeave to come into the broadly syndicated loan market? Is it just that private credit is still grappling with a wide range of other stuff? And is there any sort of interesting nuance in the structure and how the loan market may be thinking about underwriting AI infrastructure?
So I am not exactly privy to exactly why the company elected to come now, but I will say that because we have this shortage of new money deals, we had the Hologic LBO cleared in January, and then obviously everyone watched as Electronic Arts and Seal There came through. And we've had a lot of these large deals come through. The market now, there is a shortage of new money paper. And if they were going to look for an opportunity, I think this is just my guess, is that this could be a decent entry point. There has been a lot going on in high yield. And so, so far, I mean, it is a bit of a quirky structure, with the amortization and the call protection. And there's definitely things about it that it is far from like a middle of the fairway deal. But my understanding is, I mean, the day it was announced, I guess, Thursday, and by the end of the day, it was said to have been like over 2 times oversubscribed. And I think it's far more beyond that now. I've been in transit a bit, but it clearly is getting good traction. So, I mean, one deal isn't a trend, but if this goes well, I would think others in the
Mhm.
space will take notice.
Yeah, I would think as well. And what's been interesting around just leverage finance as a whole is kind of the interplay between the different markets and issuers looking across just the spectrum of, do I go high yield? Do I go BSL? Is it a private credit consideration? In April, high yield issuance was almost 40 billion and topped the monthly chart in terms of total volumes in September. So we also had about 1/3 of that tied to data center deals. We talk about data centers all the time in the IG market. It's also becoming quite the high yield phenomenon. Is there this kind of structural shift around just like every market is going to be seeing these data center financings? Is it just that, right now, high yield 40 billion in April, that was kind of the saturation point, and broadly syndicated loans needed to pick up a little bit? Or it's just, are we just all data centers all the time, every market?
I think that's a great question, Winnie. I think it'll be interesting to see how this unfolds. Timing is accelerated on the CoreWeave deal, the CoreWeave loan deal. So we'll see how where final terms ultimately shake out and where it trades and how the market holds up. And I think we can see, we'll see it go from there. But I know that some at the end of the year, some of the strategists were forecasting that we would see some loans. I think it was JP Morgan had forecast 25 billion, and that was for GCP. It wasn't for AI data centers specifically, but I think with the thought of that some of that would ultimately land in the loan space. And just given the technical environment right now, there's demand and the terms are attractive to these issuers, it seems to me like there could be an opportunity here.
Yeah, absolutely. I think it's also interesting that the kind of data center question, there's a lot of question in the kind of broadly syndicated loan market as a whole around assets and, we're first lien, but what are we secured to if we have, this asset light software PE business? Now, I think a lot of people are starting to look at, true asset intensive businesses as potentially being a positive thing for portfolios in this new AI world. So I think that the kind of data center alignment probably makes some sense if you are a loan investor trying to diversify your portfolio a little bit, still stay aligned with the tech trend, but just in a little bit of a different way.
I think that makes a lot of sense. There's definitely been a shift in sort of what compared with April of 25 and fears about tariffs to moving a year later to be worried about AI and software. There's definitely been what is safety kind of has, changed a little bit.
It's truly such a game of whack-a-mole right now with how quickly things are changing and how many open questions there are. I guess fitting in with this theme of issuers looking across the LevFin landscape, we've seen a number of loan issuers actually turn to the high yield bond market. If we have these established broadly syndicated loan borrowers actually leaning onto the bond market again to manage their capital stacks, is that saying something about the loan market? Is that just kind of an issuer by issuer consideration? How are you thinking about that dynamic?
I mean, I think there is an expectation. And as I said, we've seen it in a couple of cases. There's a deal for pods right now in market, as well as a deal for Yahoo, that are both addressing, I believe one is 27 loan maturity, one to 28, that are looking to the high yield market to refinance the balance of their debt. It, it's just in certain ways, it does not at all, but in some ways, the dynamic now with tech and loans and high yield reminds me of the oil and gas crisis, a decade or so ago, except it's flipped. In that high yield has much lower exposure and loans have greater exposure. And so I think high yield is viewed as there's a ton of pent up demand in high yield. You're well for investors to put cash to work. And I think if you're a sponsor and you're trying to optimize execution, you might say, hey, we hadn't done high yield before because we preferred lacks all protection of the loan market. But if they think it's going to improve their overall execution, this could be a place to go. So I think that's kind of what we're seeing here. This was something people on the sell side was talking about in the end of Q1, as it was clear the loan market had some volatility, and we're starting to see some deals emerge with this structure.
Yeah, it makes a ton of sense. The high yield market has posted some pretty decent returns, especially over the course of April, and had kind of a nice return to demand and retail inflows. And that is always just kind of a harbinger of, okay, we're gonna see some more supply coming into this market. So speaking of supply, you were talking a little bit about the dearth of deals, and we always look at the excellent LFI net calendar that strips out all the pending repayments in the broadly syndicated loan market from visible supply. And you guys do an excellent job of tracking all of those potential new deals. So we're only a little bit back in the black at 0.6 billion from a negative reading the prior week. So if we have a not so busy calendar of underwritten deals, what does the pipeline look like heading into the summer? Do you think that things are going to get really thin?
So to be honest, I'm not 100% sure what's going to happen, because we saw a similar dynamic. Just because remember, at the end of 2024, everybody was enthused that 2025 was going to be a big year for M&A and LBO volume. And we all know what happened. It didn't materialize. And we wound up with this situation where last year, where the net calendar wound up going deeply negative, and then it generated this huge repricing wave over the summer. It was like the busiest July. It was really not great for a lot of people involved. But when the going's good, you go. So, so there was that. This year, I feel like it's a little trickier because we still have the conflict in Iran, and I don't personally have any visibility around when that's being resolved, as well as the software concerns. And so it's interesting because that's where I'm like, how is this going to evolve? It isn't entirely clear to me. And I'm actually, while I'm down here in Charlotte, this is a question I'm going to be posing to market participants, because we watched what unfolded last year. And in some respects, it's similar. But on the other hand, there are pieces that are very different.
Yeah. Yeah, it's so interesting because looking at bank earnings, the M&A activity reported has been pretty blockbuster, but a lot of that has been the large cap and the bigger deals. And now we have things like GameStop making a bid for eBay. Maybe that comes to the broadly syndicated loan market if it even goes through. But it's just kind of a wild situation to be in. Is there something specific that would really unlock the M&A pipeline? Does it all come down to we understand what's happening in Iran, or is there some sort of broad-based pressure on sponsors to actually start to monetize deals? Is it something else entirely?
I think there's been pressure on sponsors to monetize deals for a while. And in fact, we saw a rash of issuers, sponsored borrowers put in place what are portable capital structures with the idea that they could sort of, hey, we'll pre-capitalize this document so that we can sell it and keep the existing debt in place. We've seen a few borrowers use it already, although some of the names are in the software tech space, and obviously there's sort of been a re-racking of valuations there, which is a different story. What would it take? I think definitely ironing out what's going on in Iran would definitely help. I think lower rates would help. The tech segment of the market might be a little thornier to work out. That I guess I have a question for you, sort of in light of the geopolitical situation and Owl's last meeting as chair. What is CreditSights now forecasting?
I mean, candidly, Zach and I are confused. This is tricky, right? Because everything has been turned upside down from an inflation expectations perspective. But of course, there's always that toggle between inflation and the demand destruction component when we're talking about energy. I think that it has been very well written about that consumers are really feeling the squeeze of higher gas prices, as are small and medium-sized businesses and a wide range of economic participants. So with our Q2 outlook that came out at the end of March, early April, we did shift our probabilities a little bit to assign a higher probability to our bear case, which was already kind of a stagflation type outcome. We did temper the rates expectations within them to not be as quite as severe as it once was, to acknowledge that the demand destruction component might be a little bit of a limiting factor if the Fed is indeed hiking rates again. Maybe they're not going to be hiking to 6%. Maybe it's, 50 to 100 basis points more. And that's still not our base case. That's the bear case, but we do have a higher probability assigned to that than when we once did. So we basically flip-flop the bull and the bear probabilities. In our base case, we do still think that rate cuts are on the horizon, and not necessarily for the best reason. We're still pretty worried about the labor market. I realize the March payrolls report gave people a lot of confidence that, the labor market's back on track, everything is fine. But the concentration of job ads in one specific sector, which is mostly healthcare, it's a little unnerving overall. That high level of new college grad unemployment rates is not great, and that's probably going to get a little bit of a spike in the coming months as we have a new wave of college grads coming to market in May and June. So we are expecting to see the Fed easing policy rates by one time this year, so another 25 basis points of cuts. And that actually does leave the rates backdrop a little bit less volatile overall. We have a little bit higher 10-year Treasury forecast than we initially had. We had initially envisioned it, moving as low as 3.5%. We're almost 100 basis points higher than that now. So we tempered that a little bit. And really, for fixed income investors, any sort of yield stability is going to be a positive technical. That's a really helpful place to be until people start to get worried about inflation or the labor market in a significant way. And right now, it seems like there's a lot of tightropes just being walked. I think we saw that in the Fed's decision that came out at the end of April, where you had 4 dissenters, one of whom wanted to ease policy rates and 3 of whom objected to kind of a language around prospective easing in the statement. And now we do have a Fed transition from Powell to Kevin Warsh, who we are expecting to be confirmed ahead of the May meeting. Powell will be sticking around, so it'll be interesting to see how that dynamic works. Will there be more dissents? Will there be fewer dissents? Definitely an open question. So I would say in the near term, Fed officials, just like us, really all central bankers, are looking for more clarity, and they're probably not going to have that for a couple of months or so. And I think that within that environment, you kind of have to expect that there's going to be these bursts of volatility within the rates markets. And the question is, how long can credit markets remain somewhat resilient to those bursts of volatility? Because so far they have been shockingly so. So with that in mind, Kerry, if we have a technical backdrop, which is pretty constructive, but on the other hand, a lot of fundamental concerns, AI overhang, the Iran situation, wider clearing spreads, all of these things kind of complicate the picture. How do we think about issuers who are looking at timing for upcoming maturities and trying to make sure that they are effectively coming to market and rolling their maturities forward so they don't get caught with their backs against the wall?
No, that's a great question. And I think to some extent, it depends what sector you're in, what business, what your ratings profile. There are a lot of different things. For some issuers, they don't have to pay. I mean, right now, we've had like a couple of regular way kind of names. It was a well-regarded deal for CHG Healthcare, for example, that kicked out the maturity of its loan last week by 3 years. And they had to increase, they'd reprice it to 275 back in July of 25. And this deal wound up clearing at 300. And that's not a huge deal. And also the timing is a little bit less, or actually a fair deal, less touchy in high yields, because if you price and rates are elevated, it's locked in. For loans, if you wind up getting a level. Not that anybody wants to price in the wrong market, but you can reprice it in 6 months if your biz all goes according to plan and the markets remain strong. But it's a little tricky to honestly figure out the timing, because my understanding is there have been a lot of issuers, and this is true for both loans and high yield, that for like weeks have been like no go, no go. I can't actually speak today, but that they've basically been trying to look for the opportunity to jump into something.
Yeah, it's been so tricky too because it's like the opportunity could look great at 7:30 a.m. and by 10 a.m. it's a totally different market.
Yeah. It's interesting because there were a couple of Fridays that the market seemed really positive at the end of the week. And like, oh, we're going to see a rush issuance Monday. And there was some sort of tweet or something or other that we kind of rolled in Monday morning. And we're like, oh, maybe today is not the day. But I think as more issuers have access the market successfully, I think it does seem to me that this is sort of emboldening others. You see, like, you'll see a repricing come in and you'll hear, oh, there were almost no drops on it. And that suggests, well, okay, if they were able to get it done, maybe, maybe now is the time for us to go as well. That being said, nobody wants to get a poor execution or shelve a deal, but it is a little dicey when you don't have that much visibility in front of you.
Yeah, absolutely. You never want to be the first one to tap the market or the last one to tap the market. You want to be safely clustered in the kind of middle innings of these windows for sure. All right, so Kerry, this would not be a podcast focused on LevFin if we didn't talk about private credit. We need to mark that off on our bingo card. So one of the biggest debates within the world of LevFin with the past, few months of headlines has been whether private credit's competition with broadly syndicated loans is pausing or even structurally reversing. There was already speculation around this last year when the leverage lending guidelines were fully tossed away that BSL was going to all of a sudden be able to absorb a whole chunk of deals from private credits. And now we have publicly listed BDCs that are trading at a pretty significant discount to NAVs. We've seen elevated redemption requests from the perpetually non-traded BDCs. BDC origination volumes are expected to slow now. If we are thinking about what you've seen so far in the broadly syndicated loan market deal flow, do you think that some of these issuers that would have gone to direct lenders a year ago are now finding a home in the syndicated market? Is it still the issuers are just running kind of this dual track and best execution for whatever purposes wins? How are you thinking about the interplay between BSL and private credit?
It definitely seems muted as compared with prior years. We have seen some names travel back and forth. And I will say, ever since private credit really expanded, the one segment of the market that I do feel like might continue to migrate that way are sort of sub 500 million or sub, say, $75 million EBITDA borrowers. In general, if for liquidity reasons, people like to be in tranches that are 500 million and larger. And in a lot of ways, that sort of segment of the market, I think, will continue to see folks move over. And in general, there are always opportunities. I mean, if it's an industrial business or something that isn't, I definitely think there are opportunities for both those to go both ways on an opportunistic basis. But I had posed this question to a sell side participant at a large bank as I was putting together my quarterly at the end of the year. And basically his response was like, yes, we are still looking for opportunities to poach from private credit. There just aren't as many opportunities. One thing to think about is I ran the math and I looked at the deals that moved from private credit to BSL, and about 42% of it was technology. Now, that was by volume because there were a lot of really big deals like Finastra and Avalara. And this is when we were all excited about taking all these names from private credit. And so I think there'll be, less movement within that area. But the other thing is clearing spreads have widened out pretty considerably in BSL, and why they've tightened from March. If you're saying to an issuer, okay, your existing private credit deal is S plus 475. We can get you 325 in the BSL market, but now you can only promise S plus 400. Is it worth it? And I feel like, so the number of opportunities I think may yeah, they just may not be as many cases in which banks can make a good case to poach something. And we did see some deals opportunistically leave. I imagine we'll see some more. There's also the names that change hands due to M&A activity, but that's a little bit of a different calculus if it's a different sponsor or something. I feel like it's still the same trend, but there's a different decision making process. So, but that being said, there was an LBO for a company called Learfield Communications that was an existing BSL issuer. Now, granted, they were structured at one point, but that when they got bought, new sponsors said no, go on direct lending. So we will do. I don't think it's over, but does it slow? Probably. And I think it will depend what happens with clearing spreads. If clearing spreads narrow in BSL, maybe we'll see some more such activity later in the year. The banks have done a phenomenally good job coming up with new money opportunities in light of what's been sort of either lackluster to sort of moderate M&A volume. We had a good run at the beginning of the year, and now, as we've discussed, that's kind of been depleted.
Yeah, as I found when I spent some time in investment banking, never underestimate the ability of an investment banker to figure out a deal to do. It's just always what they're thinking about. And we benefit from that with a lot of activity happening across LevFin. Of course, we have all the geopolitical and the macro, but it is always fun to talk a little bit more specifically about the LevFin happenings. And Kerry, I always appreciate your loan insights for sure. I'm looking forward to doing a nice round of client meetings with you in Charlotte, maybe having a good lunch tomorrow together as well. All right, Kerry, thank you so much for joining me today. Thank you, everyone, for listening. If you have follow-up questions for me or for Kerry, you can always find us on the CreditSights website using that Ask an Analyst function, or alternatively, you can reach out to your Fitch Solutions salesperson. And with that, we will wrap it up for today. Thanks, Kerry.
Thanks so much for having me, Winnie.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.